And a lot of people jump onto direct insurers specifically for this, and that is the cashbacks. They're going to give you 20% of your premiums back in 5 years. Is it something that people need to look at? Is it really as beneficial as the marketing guys make it out to be? Or is it a whole lot of bullshit baffles brains?
Lourens, that's always an interesting question to answer. And I think to understand the impact of a cashback, we have to understand the internal structure of what happens and how people claim. So there's basically in the financial planning and short-term insurance industry 2 ways of looking at this. Number one, your traditional cashback. For those of you who don't understand how this works, like you pointed out, you pay a premium for a set amount of time. If you do not claim during that period of time, you will get a percentage of the premiums you paid back as a cashback bonus. I'll go into a little bit more detail now, but let's understand the concepts first. The second one is what they call in the industry a no-claim bonus. No-claim bonus starts at 0 and usually moves up to around 7. What this means is for every year you are insured with a company, you get a reduction in your premium if you do not claim on that specific section of the insurance policy. And that's a very big difference to understand, because you earn no-claim bonuses on every section. So you get a no-claim bonus on your household contents, on your building, on your vehicle, and so on and so forth. Yeah. Whereas your cashback focuses on your whole policy. They don't separate it out into little different sections. So if you have a minor vehicle accident and you claim, there goes your cashback bonus. Whereby if you have a minor accident with your vehicle and you claim, yes, you do not earn a no-claim bonus, but you still earn a no-claim bonus on the other sections of the policy. So let's understand how and why.
Sorry, I'm interrupting you, but obviously, so what that means is they've basically replaced no-claim bonuses with cashback bonuses.
Yes.
And it's that whole thing of people seeing it as a big benefit because they're getting it all at once instead of getting the benefit on a monthly basis.
Yes. That is the main thing. I mean, people always like a little present and a little surprise. So it's sold on the basis that, in 5 years' time, if we use an average, I will get some of the premiums I paid back. Now, let's analyze this. First off, whenever you apply for a product which has a cashback bonus, you will notice that a portion of your premium is allocated to fund the cashback. In some instances, it's up to 15% of your premium goes towards funding your cashback.
Yeah.
So now you're paying extra, so you can get some premiums back after a 5-year period. Remember, guys, you get a portion of your premium paid back with no growth. So if you're paying 1,000 Rand on a monthly basis, you will get after a 5-year term 20% of your premiums paid back in cash, so you'll get 1,000 Rand back in cash. If you take 200 Rand and put that in an investment for a 5-year period, you'll have more than 1,000 Rand.
You'll have growth on it. And also what happens a lot is that people now don't claim for things like a windscreen, for example. They don't claim for the windscreen, they'd rather pay for it from their own pocket because they don't want to lose their cash back.
That's a very, very important thing. Yes, the rules regarding cashback bonuses have been relaxed a lot. A big reason for this was pushback from clients saying, but listen, if I now have a windscreen claim, for instance, now I lose my cash back. So yes, that has been relaxed a little overall. Please still refer to your policy wording and terms and conditions because it differs wildly from company to company. What we also have to understand about cashbacks is in the event that you do claim, not only will you lose your cashback and you have an excess, it can also have a negative impact on your underwriting in future. With a no-claim bonus, it builds up. It shows that, listen, this client is not a repeat claimer, and it's analyzed every year. So the benefit for you as a person is much bigger than, oh yeah, I've got the cash back from an insurance company, which you paid for in any case.
Yeah, at the end of the day, it is your own money that they just give back to you. I would rather pay 200 Rand a month less than get 200 Rand a month after 5 years, and rather spend that money more optimally for me. And that's also where our coaching comes in, where we teach people what to do with that money, because I think one of the big reasons the cashback is beneficial, and I use air quotes for those of you on radio that can't see me, beneficial, is the fact that if most people, if they don't get it as a lump sum at the end of 5 years, that money would be spent on trivialities and they won't lose it in any case. Where with our coaching model, whatever the guy saves goes into work for him, whether it is settling debt, whether it is building security, etc., etc. So you have to give every rand a job. So it's pointless to go from one insurance company to another insurance company. I see the adverts so often. I saved 700 Rand a month. And then I always think, but what are you doing with that 700 Rand? Next month, does it actually make a difference in your life that you've now saved 700 Rand on your insurance? Most people, I would say more than 90%, makes no difference. 3 months later, their life is exactly the same as it was when he was paying the 700. So it's all about really having control of your cash flow as well.
That's so true, Lourens. And again, it gets back to having a proper financial advisor looking after your affairs.
Yeah.
It's not about selling insurance.
There's one last thing, and I don't want. We have to get to the different sections, but there's one last thing that a lot of people have concerns about, and this is this drive or this move that insurance companies had into tracking driver behavior. So they put a little thingy in your car, and this thing can see when you brake hard, when you go over speed, and the effect of that. Because a lot of people are afraid that, firstly, the selling point there is they say that, well, if you have good driver behavior, you can reduce your premiums. The negative that people are concerned about is, yeah, but now I drive 124 in a 120 zone, get into an accident, and then the insurance company uses that information to repudiate claims. What is there reason for people to be concerned about that, or is it not really something that they need to be concerned about?
Lourens, there's two ways of looking at it. The first and most important thing is we've got rules and legislation in South Africa and all across the world governing driver behavior. If the speed limit is 120, you are supposed to drive 120. You're not supposed to take corners, 90-degree corners at 80 kilometers an hour. You're not supposed to barrel down on a stop street and then slam on the brakes. I know you want to be a racing driver. Unfortunately, you are not.
Yeah.
That's
Especially
why,
after you've watched the Formula 1 on a Sunday.
Yeah, with a couple of brandies. So, guys, realize there is legislation. What the whole tracking device thing has brought to light is it's actually made drivers more conscious of how they're driving, which isn't a bad thing. Because now they are conscious of the fact that somebody else is looking at how they're driving, and it could influence their premiums, it could influence their claim payout going forward. So that's the pro of it. The con of it is, yes, definitely, the information gathered there could result in a claim being repudiated. But the claim would have been repudiated in any case if you broke the law. While you were busy driving, driving under the influence, over or exceeding the speed limit, that's against the law, guys. If the insurance company could prove that earlier, they would have repudiated the claim in any case. So the bad side is that now these people know exactly what I'm doing in my car. The good side is, now there's somebody who knows exactly what I'm doing in my car.
And I am more aware of it as
well.
And
I am more aware of it. Yeah. Now I am looking at not speeding. Yeah. We have to also realize, just on the whole speeding thing, is if the speed limit is 120 kilometers an hour, they are not going to repudiate your claim because you drove 124. Okay, they are looking at excessive speeding.
Yeah. Also, I think people need to understand the difference between a traffic violation and a criminal violation.
Yes.
So the standard exclusion, if I understand it correctly on a policy, is if you are busy with any criminal activity or in a criminal,
Yes, correct.
then it is immediate repudiation.
Yeah.
But not necessarily traffic violations.
No.
It's not a direct repudiation.
No.
But again, if you were driving 225 in a 120 zone with your Audi TT and you write it off and they can prove it, you're going to have problems. You're going to have an issue getting the claim paid out.
It would have been an issue in any case.
Exactly.
Because that's why insurance companies have assessors.
Yeah.
They will go out, they will investigate it. And driving 220 in a 120 zone is no longer a traffic offence.
Then it becomes a criminal offence.
Then it
because it's
becomes
negligent.
reckless and negligent driving.
Yes. Yeah. Okay, so we've got another message from Warren. It says, one of my financial mentors taught me that one should never insure anything that they cannot afford to replace. Things like motor, third party or liability should be insured, but the premiums are extremely low. When I say afford, it means have the actual cash reserves or sums insured built into your reserve fund. Doing this, if you never claim, you retain the money. It forces you to have the reserve. You never have to worry about an excess, whereas your vehicle sum insured reduces whilst your premium increases. In the scenario above, your lump sum grows, where you're basically insuring something that reduces in value. Yeah, I think that comes into the whole discussion we have regarding slowly but surely self-insuring yourself, even if it's just having a excess and then increasing the excess over time. And then also, if you can get to a point where you have enough money in your reserve account to pay for a specific thing, then you don't have to insure it anymore.
Definitely. What we have to understand is three key concepts. First off, we've mentioned numerous times self-insurance. Let's just understand what self-insurance is. Self-insurance is you becoming your own insurance company. So instead of paying an insurance company a monthly premium, you take that premium and you put it into a type of savings account. The problem is most people don't have the discipline to realize that money is to replace my cell phone or my laptop or whatever the case might be. So it needs to be kept separate from all your other financial planning, because this would then be a true emergency type of account. Secondly, we have to realize it takes time. Very few people on this planet have enough funds available to go, oh, right, I'll just transfer 20,000 Rand over and now that's done. I'll go on with my life. So it's an account we need to build up over time by making use of practical and educated financial education.
Yes.
Having somebody help us and mentor us and monitor it for us. The last and most important thing, there are just some things that you will almost never be able to self-insure. The average house in South Africa, looking at the middle class, is around about 1.2 to 1.5 million.
And to replace and rebuild is more. It's like 2 million, 2.5
Very
million.
much so.
Because people don't take into account, and we'll get to that thing has to be broken down first. Everything has to be taken away, then rebuilt. They just think, well, to build this house is going to cost me 1.5. It's not. There's a lot of other work that needs to be done.
Very, very true. So there are unfortunately some things we will always need to have insurance for. Probably the most important one would be liability, because liability insurance can run into the millions.
Yeah, and I think here's the big thing, is having that capital sitting there idle for things like a house. Let's say the house is insured for 2 million Rand. Let's say you could put 2 million into account and say, that is me self-insuring my house. Now the money is basically sitting there idle, waiting for you to claim your house. That money, if that money is allocated and used to invest in some kind of an investment, you could probably earn 3 or 4 or 5 or even 10 times monthly the income that it is costing you to insure that amount. So you must look at what is the capital worth if it sits in an account, against what it could generate for me if I put it towards an investment or something like that. Because your house might be 700 Rand a month, but if you take that 2 million, you invest it in a business asset or a fixed asset, you could generate 4,000 or 5,000 Rand a month from that. Then it's not worth it anymore. So it's sort of now I've got this picture in my head of a graph of at some point it will reach each other where it's not worth anymore having the capital on hand and saving the premiums that you're paying.
That's so true, Lourens. Do yourself a favor, all our listeners out there, go and look at, and let's stick with your building for now. Go and look at what is the insured amount of your building and what's the premium, and then divide the insured amount by the premium. Risk cover is normally geared towards it being physically impossible for you to pay in premiums more money than you would get out in the event of a total loss. Okay, so yes, we reach a point where those two lines converge, where it's cheaper to actually pay for insurance
monthly, than
and
use
invest
the capital.
the capital in some form of income generating asset, than saying, I'll have this capital in reserve. The problem is, guys, if we have this capital in reserve, it needs to be true capital in reserve. We can't have it tied up in an asset, because if your house burns down, you need access to that capital, and you need it quite soon.
Yeah, you can't wait 8 months for the property, say for example,
to be sold, or whatever the case might be.
So Warren comments, he says, agrees with your points. Maybe looking more towards the expensive insurance types like credit risk, all risk, motor, watercraft. Exactly that, Warren. You're getting the point exactly. It is those things like your cell phone, for example.
Yeah.
You could replace your cell phone for a second hand or whatever for the same cell phone you had for say 7 grand. Now you're paying 150 Rand a month for that. To have 7,000 Rand in reserve and save that 150 is worth it. But getting to stuff like property and cars to a large extent where it's huge amounts, then you don't always want to have that capital sitting there idly waiting for you to have a claim.